Good afternoon, everyone. CCI Toronto is pleased to offer you this webinar. So whether you are a board member, unit owner, or a professional services provider, we're excited to have you as part of today's webinar. My name is Mario Deo, and I will be your moderator today. I am a condominium lawyer with Fine & Deo. Our panelists today are Catherine Gao, a property manager with Crossbridge Condominium Services Limited, and Christina Adjith, an accountant with Adams & Miles LLP. Before we begin, I would like to provide you with a few suggestions and hints, as this might be the first webinar you've attended, or you may need to familiarize yourself with the layout of your computer screen. Number one, we welcome questions, and you'll see that there is a box at the bottom of your screen that reads, bottom right-hand corner, chat. This is where you can submit your questions to the panel and other attendees won't be able to see them. Please note that we'll likely be saving all questions for the end of the presentation, and we'll try to get them all as time permits. If you experience technical difficulties, send your problem through to the chat option at the upper right of your screen, and our technical staff who are also on the line with us will respond, and we will get you the help you need. We will be sending you out an electronic survey after the webinar, so please take a moment to respond to it so we can continually improve our webinars to best meet your needs. The presentation deck will be posted and a link will be sent to attendees with the follow-up survey. A link to the recording of the webinar will also be shared in the coming weeks. We would like to thank our CCI-T partner sponsor, First Service Residential, and our CCI-T virtual platinum sponsor, Duca Property Management, and the other sponsors on your screen for helping to make today's webinar possible. For those of you looking for additional condo education opportunities, please consider signing up for our next seminar taking place on Tuesday, July 16th on the topic of climate change. Details are on our website. And finally, you will see a notice at the bottom left of your screen about CCI-T's Condo of the Year Award. Please note that the submission details have been extended until July 31st. Details and the application form can be found on our website. All condominium corporations should consider applying, even if you're not the biggest or the best, but have a story to share of a challenge you have overcome and are now on the way to becoming great. We want to hear from you. Now, let's begin today's session. Christina, can you tell us why budgets are so important?
Sure, Mario. So budgets are important because they're a key part of the effective governance of a condominium corporation. So if you step back and think about a director's roles and responsibilities, it's basically to run the condominium on behalf of all of the owners. And part of that responsibility is to manage the condo's finances on behalf of the owners. So owners are paying their fees, which is their hard-earned money, into the condominium, and they have a reasonable expectation that those funds are being spent responsibly and checks and balances are in place. And budgets are just one of those checks and balances. Directors and managers should be using budgets as both a planning and a monitoring tool for the condo's finances. When budgets are used well, it can result in a condominium having enough money in both its reserve fund and operating fund for both regular day-to-day operations and reserve projects. When budgets aren't used effectively, on the other hand, we've seen the horror stories where condominiums end up with either an underfunded reserve fund or just continually having to levy special assessments on owners for projects that are coming up, or there's just not enough money for operating costs. So I mentioned that budgets are not only a planning tool, but they're also a monitoring tool. Once an initial budget is developed for the year, monitoring the actuals against that budget can help control spending within the year. And it can also help identify or pinpoint any potential issues. Another thing to note is that it's important that budgets are not only created on a timely basis, but they're approved on a timely basis. Practically speaking, even though it's the board's responsibility to develop the budget, oftentimes that responsibility is delegated to property management, as they might have better expertise and resources. So once management creates that budget, it's important that the board look at it, be asking the right questions about the assumptions, and then approving it on a timely basis. It's also important that that approval is formally documented in the board meeting minutes. So overall, just even in life, it's prudent to plan and think ahead, and budgets are just part of that process to plan how the condominium's funds are going to be spent, and also identify potential savings, or also where things might be going wrong. So there are three components to the budgeting process, or three things you should consider when budgeting. So one is the operating budget. That's regular day-to-day operating costs. For example, utilities, contracts, repairs and maintenance, the annual allocation to the reserve fund. So when you're looking at your financial statements, these costs are in your income statement or your statement of revenue and expenses. The second component is the reserve fund budget. So this is specifically planning for major repair and replacement of the common elements and assets of your condo. So we'll get into this a bit later, but the reserve fund study that's prepared by the engineer can help the condo plan for these reserve fund items for both the timing and a dollar estimate. And the third component is your cash flow budget, which sort of falls out of the first two. So cash is king, as they say. So you always have to be monitoring whether there's enough cash or funds to cover the obligations of the condominium. A lot of the time, if the accounting is done correctly, that cash will follow whatever is showing in your operating fund and your reserve fund. So I just outlined some of the various types and budgets, the various types of budgets and why they're important. But I think timing of developing your budget is equally important. Are there certain timelines, Catherine, for when condos should be developing their budgets based on your experience?
Further to your comments with respect to budgeting and fiscal responsibility being really important governance items and an effective means through which the corporation can be monitored, budgeting is a 12-month process. And I want folks to consider that. But at the end of the day, the nuts and bolts of building up your budget does take place in a timely way in order to ensure that the board has the opportunity to review all of the information the manager has amassed in making their approval. So I'd like to split up the final budget process coming up with your new fiscal year's plan by looking at the contracts and reviewing your spending in month 8. I don't mean in that way that we're going to recontract everything, but I do want the review to take place. In the 9th month, you're going to be projecting to year end. You're going to be making certain assumptions, and it's a great opportunity to test certain assumptions while you are monitoring to the year end. In the 10th month, you're going to complete your draft and have a meeting with the board. We'll talk a little bit later on about how board members can best prepare for that meeting so that it can be effective and so that they can make specific changes where they are warranted or desirable. The 11th month will be to finalize the budget, to add in extra wish list items, to tidy up some of the notes so that they're very clear. And of course, in the 12th month, you're going to communicate with homeowners. And we'll talk a little bit about that and delivering bad news a little bit later on in the presentation. During the month, just as Christina has identified previously, you're going to be monitoring your budget. You're going to be reviewing the assumptions that you had made when you budgeted, and you're going to also make yourself some notes so that you can do a little bit better next time. Remember that budgeting is a tool. It is about collecting fees for homeowners so that you can have that cash flow that Christina just spoke of, but it's also about planning and making certain assumptions. And the more notes you take, the more you review it, the better a budget you'll be able to build next time around. When we go to talk about those specific month tasks, the first one I want to tackle is the contract review. What I like to work with my managers and with my boards is a contract summary. You're setting yourself up for failure if you're going to try to contract each of your contracts in the 8th month and every year. Instead, what you want to do is have clear terms, to have reflected on all of those terms, and to take a look at the specific rates that will be involved in the anniversary dates that will come in your next fiscal year. Prepare yourself for the increases that you will anticipate under contract. And there are things like labor rates that may have an impact on existing contracts that you'd like to confirm during this 8th month. The other thing that this enables you to do is to plan your workflow for the next year as well. There are a lot of maintenance and repair contracts that are routine contract payments throughout the year, and planning an opportunity to review all of those terms and conditions in great detail and make modifications to performance levels or visits or any of those items is best contemplated when you've got a real opportunity to tender that project properly. The other thing that I want you to think about is, from your wish list of your last year's budget, what service increases or changes had been contemplated? Do you have security only part-time during the day, and had they always wanted full-time? Now is the time to build that into your budget. I like to call it fully loaded. All of the costs we have always dreamed of, and then after, kind of you pass out from the increase, you can pick yourself up off the floor. You can take a look at what that will mean to the dollars and cents of monthly expenses, and you can make an educated choice as a board together with your manager as to whether or not you'd like to implement those changes. When we talk about projections to the year end, what you're looking at doing is identifying what spending you will actually complete. Sometimes, and especially this year on account of COVID-19, there are a great many of the springtime tasks that maybe will not take place during this springtime because we had so many contracts that we didn't fulfill during the emergency order. And so that is going to take some thinking, whether you're going to order it and try to complete it before your fiscal year, whether that's going to push or change some of your spending along. Money, of course, keeps flowing throughout the entirety of the year. And so what you're looking to do when you're putting together your projections is how much money you'll be carrying by way of surplus or deficit into your next fiscal year. The other thing that I think is really important, and this is further to the governance piece that Christina spoke to earlier, the information from your projections is going to be included in your periodic information certificate. And I think that the reason for that periodic information certificate was to help homeowners connect the dots between all of the communications that we have in condo land so that they really do understand the fiscal health and the plan for finances in their condominium corporation. When you get to month 10, we're talking about building. So you're taking some of those items, some of those assumptions from contracts, some of the consumption factors, and you're going to build out your budget. And when we build it, we like to talk about, or I like to think about spending in certain buckets or categories. And we'll go through each of the spending categories in a little bit more detail so you can understand the thought processes that as a manager you should apply when you're creating a budget. And so as a board, you can also evaluate the assumptions that have been made. Remember, budgeting is educated guesswork. So part of what you're going to be testing or asking about is, what did you assume? What are you planning to have happen? What are your provisions for change? And so each of those spending categories that we're going to talk about in a little bit more detail are your utilities, usually about 30 or 40% of your budget. Repair and maintenance categories, the lion's share of what we do as managers and boards, keeping our properties looking beautiful and in good repair. Special projects. Staff remuneration, this is a big one to think about very carefully. Administration, which is also the bucket full that has things like insurance and legal spending, which we'll talk about more too, and surplus or contingency funds. That might be a good opportunity to lessen an increase or implement a special improvement project that the corporation's always dreamt of. And finally, of course, again, a big spending category is your reserve fund allocation. First and foremost, the utilities.
I think, Mara, you were muted, but I think were you asking me about utilities?
Unmute.
Okay.
I was saying, Christina, utilities is one of the, or are one of the biggest buckets of budget costs. Let us know a little bit about how boards and managers can handle that. And thanks for the heads up.
Sure. So utility costs are impacted by two factors, rates and consumption. So basically, you take your expected rates, multiply it by your expected consumption, and there you have it. You have your expected utility costs for the year. So when budgeting for utilities, you should be considering your rates separately from consumption. So rates, firstly, they're not likely to jump significantly year to year. So you could start with this year's rates and then factor in an increase for next year. That's one approach. Also, the Ontario Energy Board publishes gas and electricity rates online, and they also communicate various credits and rebates that they're offering. So it's important to monitor these websites for the rate announcements and for any incentive programs. So when you look at your bill specifically for electricity, there are different types of rates that might apply and various charges. So you'll see on the slide here, we've outlined for you the breakdown of the different types of pricing for commodity charges only. But on top of commodity charges, there are also distribution and transmission charges. So there's a lot of details here. I'll just go over it at a high level. For the commodity charges, the ways you could be billed are either based on time of use, that's the first category there, or hourly, that's the second one, or based on a regulated price plan, that's the third one. So under the time of use billing, there are typically three different prices on your bill or three different rates on your bill based on the time of day that electricity is being consumed. So up until October 31st, 2020, there's special COVID-19 pricing and some rate relief in that your condominium, if you're using the time of use billing, you're only getting charged at one fixed rate, which is 12.8 cents per kilowatt hour. And that's regardless of what time of day electricity is being consumed. Under the hourly plan, so that's the second category, your condos are paying normally a relatively low hourly rate plus a larger global adjustment. And both of these are typically market driven and they change monthly. But under COVID-19, there's again some rate relief in that the second component, that global adjustment, which is typically larger, that's being fixed at 11.5 cents per kilowatt hour. And the third type of rate is under a regulated price plan. So under this method, the commodity charges are typically fixed based on a forecast that's done for the year, and then prices are reviewed twice a year and reset. So similarly, under COVID-19, the current pricing, it fixes the tiered pricing. So tier one has a fixed rate of 11.9 cents per kilowatt hour, and the second tier has a rate of 13.9 cents per kilowatt hour. Another thing to consider for rates is the Ontario electricity rebate. So this is a rebate that Ontario is giving certain eligible residential and commercial customers, and those eligibility criteria are changing on October 31st, 2020. So you should discuss with your property manager to determine if the corporation is going to be eligible going forward. And that eligibility criteria, it's outlined in that table, but in a nutshell, it's based on how the corporation's electricity is metered. So both in the common areas and in the suite. So that's something just to maybe talk to your property managers about. So during your budgeting process, it's important to look at your bills to see what the corporation is currently paying for, and then monitoring the news, the Ontario Energy Board website, and also municipal websites to look forward to what kind of rates are going to be in place or not in place, and then factoring that into what your budgeted rate is going to be. So it seems daunting, but it's important to go through this exercise and try to be as precise as possible. Developing your utility budget, this is an annual exercise. So the more precise you are, the more unlikely the corporation is to experience those significant fluctuations to budget. So we've talked about rates. Now, the second component is consumption. Consumption in gas, electricity and water can be driven by several factors, both inside the condominium and outside. For example, how hot was the summer, how wet a specific season is, how cold the winter is. If Airbnb or other short-term rentals are permitted, that might increase consumption. The demographics of the owners. If you have a lot of owners that stay or work at home, for example, now with COVID-19, consumption, if the corporation is covering certain utilities consumption, that might be higher than this period of time last year. So a lot of the time, these factors will average themselves out over time. And it's quite difficult to predict what will happen with all of those factors in any given year. So what we recommend is to look at a 3 to 5 year average for consumption. So the past 3 to 5 years, because this will help normalize for any extremes in weather or circumstances. So for example, this year's spike or potential spike in consumption, it's likely not expected to reoccur to the same extent year over year. So if you take an average of consumption for the last 3 to 5 years, it can be a good base for expected consumption for your condo going forward. And it's important to track this data from day one of your condo or just from this point forward. This might seem like a meaningless exercise. You're just tracking consumption data from your bills, but past information or history is vital in predicting what is going to happen to some extent. So you can take your average consumption for the last 3 to 5 years and then look forward to the next year for anything else that might impact consumption. So for example, if you know a lighting retrofit project is planned, that you may know that electricity consumption will be lower, so your electricity costs will be lower, or a certain reserve fund project might also impact consumption. If you expect maybe heat to be lost during a parking garage renovation, build that into your consumption expectations, or increased water leaks while certain things are being repaired. Those are some other things to consider as well. So another one of the buckets that Catherine mentioned is key, that a lot of property managers' time is spent on, is repairs and maintenance. So there are two components to repairs and maintenance. One is the contracted or committed spending for a year. For example, you've got certain landscaping contracts, cleaning contracts, HVAC, elevator, garage power wash, window cleaning. So these are predictable and they can be mapped out in terms of timing and also estimated costs. And the other component are the extras. So for example, plumbing costs for leaks or some electrical work that's not expected. So to help plan for this type of spending, it's helpful to have a maintenance schedule that outlines the plan for various systems and building components. So if the history of this schedule is documented well, you can tell that there's a cycle of maintenance. So for example, certain items are done semi-annually, some are done annually, some every other year, every 3 years, you get the gist. So this timing can be incorporated into your budget. So for your repairs and maintenance budget, you'll have the fixed annual component for any contracts or committed spending. And then you can build into that any other anticipated spending based on your maintenance schedule. And then on top of that, you can then build in a contingency or a cushion for extra spending. And to make planning and monitoring of your repairs and maintenance more efficient, it also helps from an accounting perspective to separate the tracking of your repairs and maintenance costs between those various components. So split out your committed, contracted, or recurring costs versus your extra spending into actual different general ledger accounts. So did you have anything to add, Catherine, just from a property management perspective about repairs and maintenance budgeting?
I did. And a couple of things specifically, your thoughts on trying to spread out some of the spending that doesn't happen each and every year is especially important for condominium corporations that have relatively small budgets. So as you can well imagine, if you happen to be a condominium corporation where your overall budget is less than $1 million, the routine process of cleaning horizontal drains and vertical drains is actually very expensive. Two schools of thought on how you might best accommodate that special but routine spending is to speak with your reserve fund planner and have those routine maintenance items included in your reserve fund plan. It is for major repairs and replacements, and it can serve as a terrific reminder. We all know that boards have elections for directions each and every year. And what that means, of course, is that there's opportunities for change and a possibility of missing some of those cyclical spends on maintenance and repair items that are important. The second school of thought on how you can best accomplish a smoothing of those expenditures over time, over multiple years, is to have a plan that ensures that you are doing those specific projects from a maintenance and repairs perspective on differing years. So you have one special project. They're often invasive in terms of accessing homeowner units and things of that nature. And so that can be beneficial to the community as well. As a condominium manager, you are going to be the first person most often to identify those special needs within your community. It is part of your regular operations to do walkthroughs of your site and identify things that require repair and maintenance, like the walkway, perhaps not a reserve fund project. Maybe what you want to do this year is pave that area, the grassy place that everybody cuts through in order to get to the bus stop that we can never keep grass on. Those are items that you want to track. You maybe had a price for last year and we never did implement. Again, using the concept of a fully loaded budget, one where we put in everything we ever talked about spending, it can help us to identify what is realistic for our final plan. The other thing that your property manager, of course, will know in working with their contracted service providers are the timelines for specific teardowns of the air conditioning unit, when boiler refractory bricks need to be replaced, and those can be included. Again, making sure that they're either covered in the reserve fund as part of your plan or they're identified as your operating spend special project. The other items that will go into wish lists are some of the new equipment improvements, guest suite modifications. You just want to spiff it up a little bit with some nice drapes and a comforter, and garden enhancements, new furniture for special areas. Admittedly, this season we might be doing a lot less furniture and equipment installations because our thoughts are motivated by COVID. So the other thing in terms of special projects and differences this year that I do want everybody to think a little bit about is new spending that we've become aware of on account of COVID. And those things involve personal protective equipment. As we start to reopen in the city of Toronto, our need for it is going to be increased. We've all experienced the new installation of hand sanitizer stations and plexiglass barricades in certain areas. And thinking will and should involve what might be necessary on a going forward basis in order to enable us to make use of those areas safely. Because COVID is going to be with us for a longer time than any of us would hope. The final thing is we've accomplished a lot with, bits of masking tape or paper signs that have been laminated. But knowing that COVID is going to be with us for a while longer, we might want to consider for budget purposes some more permanent signage that we think reflects our brand, that we're a little bit more proud of in our home environment. It starts, I think, to make it feel more regular and routine and less like an emergency zone if we do some of those things. The other bucket that we talked about earlier was staff remuneration. And you're going to have staff probably in two categories. One is going to be contracted staff, and that'll be an update of your contract, keeping in mind with your contractor that there will be an increase to the minimum wage come October. Unlike past increases, which were really substantial, this increase is posted currently to be 25 cents per hour, so it's probably accommodated relatively easily. The other things that I want you to consider, especially this year on account of COVID, is perhaps some extra budgeting for relief costs. Some of the corporations have already or will be awarding essential worker pay, if you will, so some extra wages to contracted or in-house staff. And I do think that we should look to accommodate extra illness, time away from the job, either to care for children, care for relatives, or on account of illness ourselves. The final thing, and in particular, if you have employees of the corporation, I believe that you need to contemplate, and perhaps now is forcing the question in communities that haven't given it a great deal of thought in the past, a contingency. one way or another, and whether they're the best employee that we've ever had or somebody that we need to move on because we're not pleased with their performance, terminations are necessary. And the reality of it is that terminating the arrangement, engagement of an employee can be costly. And especially when you're talking about an annualized budget, it can be more than an individual year can bear. And so you might want to consider a contingency for those reasons. Also for a retirement gift. Somebody who's been with your corporation for 20 years, you might want to, when they choose to retire, give them a little gift or a token of appreciation. And finally, if you have live-in staff in particular, what will happen during an extended period of absence? This is also a great thinking tool for making accommodations in future planning. You want to have a stable workplace and workforce. There are also going to be a lot of new training requirements, in particular if you have in-house or employees of the corporation. You want to make sure that they have all of the best advice and information that they need so that they can be safe through this period. The other big bucket of spending that we had talked about earlier was administration. And this tends to be a catch-all for a lot of our special spending. The majority of your consultant spending is admittedly going to go through your reserve fund. But in addition to that, we often seek professional opinions for special, noise disturbance issues, elevator audits, appraisal of the corporation for insurance purposes, very important to make sure that you are fully and properly insured. The other new things that I want managers and boards to think about this year, as well as just plain modernizing, COVID has necessitated virtual meetings, just like this one. In the past, we would have gotten together and I'd be able to see and talk to you a little bit more or differently in our meeting setting. What I want you to consider is whether or not you will need some special virtual meeting toolkits, headphones, microphones, cameras, in order to make your virtual AGM, for instance, a really successful event. We spoke a little bit earlier about extra costs related to hand sanitizer, extra cleaning. If you haven't already done so, your corporation might consider the application of a product that has enduring microbial antiviral capabilities or properties. There are lots of brand names out there. We've seen things like Microban, for instance, put straight into children's toys, and it's the same type of concept for the common elements areas. I do believe it's okay to have food and water. It's very different if you're ordering, champagne and having caviar. But I also think that sometimes our meetings go long, and to have a little bit of sustenance, especially when you're coming straight home from work, is not out of the question. Insurance premiums are on the rise. That's no surprise to anybody out there. Do connect with your broker to find out what a reasonable provision in your budget might be. You notice that I've left off to the end and right to the end some of the things that I think you're probably worried most about or thinking most about. And that has to do with what we should budget for legal fees. And handily, the moderator of our session is Mario, one of the finest condominium lawyers there are. And I wanted to ask him specifically about a couple of things. One, what we have to think about when we consider some of the new spending that I talked about in connection with COVID requirements and opening up amenities. And second, things that we need to consider from a legal perspective. I mentioned the virtual meetings and everything, of course, already.
Thank you, Catherine. There are needs for opinions. We have received many of them. With respect to amenity reopenings, the biggest worry is liability. And everybody is expecting, a spate of lawsuits against possibly condominium corporations, security companies, etc. We don't know if they're going to materialize, but everyone's worried about it. And that's the biggest worry. So what have the corporations been doing about amenity reopenings? Disclosures or releases that are signed, believe it or not, before the use of the amenity. Disclaimers can be posted. From a legal perspective, not as effective. Releases are signed. Not always effective, but that's what some of the condominium corporations are asking for, and we're providing. And the warning is, not all releases are going to work. Warning signs everywhere for amenities. And, you know, all of that is sort of the bad news. I don't know if this is good news, but I think most condominium corporations have insurance that will cover a COVID lawsuit. Now, there are exceptions to certain insurance policies, and you should check with your broker. I think that's a very important thing to do. Tell your broker, we're opening amenities. Do we have, in the event we get sued for some COVID cases, do we have that coverage? Changes to policies. And this is a huge topic to cover in such a short period of time. What most condominium corporations are doing are limiting the number of people to amenities or keeping them closed. Depends. It's a board decision. The key is to, you know, keep the corporation common elements safe for the residents. That's the key. What a lot of condominium corporations are doing, secondly, is they're having sign-in for the use of the amenities, not for anything except to trace if there is a COVID case. That's why they're having sign-ins. And that will reduce liability, probably, in the event that that happens. In terms of a budget, I think Catherine's covered that. Extra cleaning, supervision. Now, yesterday I was asked by a townhome condo, we have a pool, but we've never had supervision at the pool. We want to open it. What a huge discussion. Do you open it? Do you have somebody sign in? Well, we don't have the budget for that. We've never had this. We're only 50 condominiums, but we want to open the pool. I can't even cover that question at this webinar. There's so many ways that it can be done. You know, can you use volunteers? Do you have to put in extra in the budget so you can have somebody sitting there 8 hours a day or how many hours the pool is open to sign people in and out, or to make sure, the biggest thing is to make sure there's not more than X people in the pool. On and on. Virtual meetings. Sorry, I have to move on. It's a great topic. I'd love to talk more about it. Virtual meetings and bylaws. Right now, there's a ministerial order that no bylaw is required for electronic meetings. Electronic meetings includes virtual meetings. Yesterday, I was speaking to a client. Their meeting is going to be in October. And they're asking me, okay, we can pass the electronic bylaw in October. Catherine, yes or no? Just nod. You can't do that. You have
need
to.
a bylaw.
Yes. A bylaw is only effective when it's registered on title, and you can't do that at the same meeting. You have to have the bylaw before your October meeting to have the virtual meeting. And in October, a lot of people still won't want to see each other. So a lot of condominiums are going ahead with their electronic bylaw. And by the way, it's a very simple bylaw, and it's passed by a simple majority at a meeting. And most condominium corporations are simply doing it by proxy, by electronic proxy. You don't need an electronic bylaw to receive proxies. So it's perfectly well done that way, and that's the way it's mostly being done. And the virtual meetings, they do cost a lot more. They're about $1,500 to $2,500. And they're tending to work pretty well. They do have some quirks. And there's an important caveat about these virtual meetings. There are certain procedural items that may be of concern, but I think the courts and the judges will be very lenient if there's an objection. But you do have to cover your bases. You know, my concern is, what do you do with the people that don't have a computer and maybe don't want to submit a proxy and they want to attend? Well, right now they can't attend. So what is the legal ramification of that? We still don't know. But in virtual meetings, we just hope that they're going to work out well. I think they will. So far, they have. Now, there's quite a few buckets of costs that we just went through. Depending on how the actuals pan out, Are there any comments that you two have, Catherine and Christina, on what the common sources of surpluses are and what corporations can do with these surpluses if they're lucky enough to have them?
Sure. So, considering everything that we just went through, the one bucket that, in our experience, has the largest variances or differences to budget is utilities. So, you can put the work in to predict those rates and consumption to minimize that difference. But we still do see at the end of the year a lot of either savings or losses resulting from those utility differences to budget. So, if it's a surplus in that came from either utilities or anything else. So there's a couple of options. You can maintain those surpluses in your operating fund, you can build a contingency fund, or you can transfer those savings to the reserve fund. So the operating fund, that's all of your condo's accumulated surpluses and losses from day one of your condo. So the purpose of this fund is not to build it up excessively, be collecting money from the owners and just have that sitting in a bank account and not being used. But instead, it's meant to be a rainy day fund to dip into whenever needed. So if the board and management is doing a good job of budgeting, you'll rarely have to dip into this fund. And that doesn't mean it shouldn't exist. It's good to have a cushion. And best practices suggest that condos, as not-for-profit organizations, that they have 1 to 2 months of maintenance fees in that operating fund in case any unanticipated expenditures come up. So for example, under COVID-19, there may have been increases in utilities that were experienced due to increases in consumption, and also additional costs that weren't anticipated. For example, additional cleaning, sanitation, security costs. So those definitely were not anticipated a year ago when budgets for this year were being built. So if you have a bit of a cushion in your operating or your contingency fund, this could help with that potential blow to the condo's finances. And just another side note, if you find yourself in a crunch and there's additional costs, but there's nothing in the corporation's operating or contingency fund for those operating costs, you can consider an operating line of credit or temporary financing. So just remember the key word there is temporary. That eventually has to be repaid. And as always, the bill always falls due on the owners. So Catherine, do you have some experience with what contingency funds can be used for as well?
One of the issues in condo land is, you're looking to keep your property at, brand new status. And if anything, increase it a little bit over time. You want to add, kind of some new furniture on the roof terrace, some new equipment into the fitness center, some beautiful new perennial gardens. And the problem is that there's very little discretionary spending is the truth of the matter at the end of the day in the budget. And so building a small contingency for some of those special projects known in the community that you're going to want to implement them in future can be the best way to fund it. Philosophically, I believe that the intention of condominiums and their budgets is for predictability in spending. And so the other reason for that cash flow surplus that Christina spoke of is to also absorb the fact that we don't spend money evenly through the year. And we'll talk a little bit later about budgeting so that you are, matching your months and your expenditures so that your variance report makes sense. But the other thing that you have to think about or consider is that your electricity bill is going to be much more, for instance, in the summertime, and your heating bill, your gas bill is going to be much more in the wintertime, but you're collecting the same amount of fees every month. So that surplus amount is going to help you manage those curves. The other thing that it will enable you to do is budget tighter when it comes to utilities. Elsewise, you're starting to make as a corporation some fairly kind of limiting choices about what you could do. And I never want corporations to have to limit their consulting with special experts. It's our get out of jail free card. It's how we know and can document to our homeowners that we have done all of the heavy lifting, we have exercised our duties. This surplus can, of course, be used with a view to a zero increase budget. My concern whenever we're doing that is whether we are kicking the can down the road and creating a bigger problem for ourselves next year, or whether we are truly absorbing an unusual or exceptional cost, and one that it is good work to use our hard-earned savings on, because it's hard-fought money to get a surplus in a condominium budget. And so by that, what I mean is you are living on your credit card if you are using your surplus in order to fund this year's operating budget. And the problem is next year, if you have the same operating costs, you will not have that extra $50,000, $100,000 in order to support those operating costs. And so you've really crippled yourself for next year, because in addition to the regular increase that comes with the rates that Christina mentioned earlier in the presentation from a utilities perspective, you have to find another $100,000 that you've already spent and you certainly didn't collect in this past budget year. So that's the thinking that we have to use when we're deciding on whether or not we want to apply a surplus in order to save the increase this particular year. And the other question I often ask boards, and we'll get onto this a little bit in the decision-making process, is how much pain in using that surplus are you taking on for how much, celebration at the condo owner level? Nobody likes increases, but they can be well understood. And I guess that's the way that I will leave it at. It gets us then on to kind of the next piece of good consideration of how we're going to use funds, operating and reserve funds, and how to plan best to make those increases as level as possible over time.
Okay. No, I'm not muted. I am talking about Section 97 and what directors and managers should be considering for their Section 97 obligations. In Section 97, when you read it, it doesn't seem like it because a lawyer wrote it. But it has three categories. Section 97 has three categories of expenditure for improvements, okay? There's other categories, I'm gonna get to them. The first category is change by board resolution, okay? There is no requirement for a notice to owners or a vote or anything if the board decides to make an improvement, not a repair, not something that's eligible under the reserve fund, but an improvement to the common elements if that improvement is less than 1% of the budget for that year. Nothing required, just a resolution. We don't have time to go over what is an improvement and what isn't, but basically common sense. Changing carpet to marble, that's an improvement. The second category is anything that costs between 1 and 10% of the budget must be made with notice to the owners. And the notice to the owners says you can call a meeting by getting 15% of the signatures, just like a requisition. And if there's no notice called, then the board can spend that money between 1 and 10% for that improvement. If there's a meeting called and the vote passes at the meeting, the board can go ahead. If the vote fails, the board can't go ahead. Then there's items that cost more than 10% of the budget that are improvements. We're not talking about repairs, remember? We're not talking about obligatory expenditures that are decided by the board. We're talking about improvements. If it's more than 10%, then a meeting of owners must be called, and 66 2/3% of all of the owners, not just the owners at the meeting, must approve the expenditure. So, can money be spent by the reserve fund? This is sort of another category under Section 97. It's not the three categories for improvement, but for improvement, you can't spend reserve fund money. Okay, that's the first thing. But for other exceptions under Section 97, you can spend reserve fund money, and those are the exceptions under Section 97(1)(a) and B. Money for the safety and security of the condominium corporation, and money for compliance with legislation. The obvious one for safety and security is if you have to, improve the common elements to be safe. It could be, physical distancing. It could be an extra service that you might have to hire an extra security guard for COVID, for example. That would be something that you don't have to go to the owners for because it's for safety and security. That's an easy example for that. An easy example for compliance with legislation is EV charging stations. If a corporation has to put in some more infrastructure for EV charging stations and it costs even more than 10% of the budget, sometimes it does, they don't have to go to the owners for that. And Christina might disagree with me, but we think that is reserve fund exigible or eligible. Christina's, not on mute, but she's not talking. Oh, she is.
She ends up being the condo police, though, and so I do definitely want to hear what Christina's input is on whether it is reserve eligible or not. And I'm, of course, thinking about the notes that she puts into the audit every year. So maybe you can talk a little bit, Christina, about operating versus reserve funds, because I know it can get messy, which is what you hate the most. So maybe you can help us to be good housekeepers on keeping our funds straight.
Sure. Yeah, definitely. We as auditors like to be clean. I'll get to that eligibility thing in a second, Mario.
Hey, wait a minute. We like to be clean too, eh?
But we do, at the end of the day, the Condo Act is a piece of legislation that's law. We are not lawyers, so we will not look into all of the nuances and details. So we do refer to legal counsel sometimes for those murky reserve fund expenditures.
We dance together.
Yes, we do. Yes. Okay, so operating versus reserve fund. So we discussed all of the various buckets of operating costs, and it's important to understand that the operating and reserve fund have two separate purposes. You should try to avoid those year-end reallocations from operating to reserve. So at the end of the year, we've seen sometimes corporations end up with an operating loss, and then what they're doing is accountants are being given instructions. Can you scour through the repairs and maintenance account and see what type of cost we can reallocate to reserve so you can get rid of that operating loss. So that allocation or assignment of whether a cost is operating or reserve, that should be done consistently throughout the year, and that should remain at the end of the year. So the reserve fund, that's restricted for major repair and replacement of common elements and assets. So that's the definition from the Condominium Act. Don't be afraid to use the reserve fund if the cost actually qualifies. So if it's a major repair, it's something that's not reoccurring, it's not regular maintenance, or it's replacement of an existing common element or asset. Reserve fund spending, it helps maintain your building or your complex, which then in turn impacts your market value. So you should be using it if it's an eligible reserve fund cost. Something else that might help with your reserve fund spending for efficiency purposes is to have a policy in place that sets a certain threshold. So for example, anything under maybe $1,000 or $5,000, depending on the size of the condo, that might automatically be an operating cost. And anything that's over that threshold, there needs to be a determination of whether it meets the definition of a reserve cost or not, and then recorded appropriately. So this helps save time so that the determination of operating or reserve, you don't need to be doing that for every single invoice that's coming in the door. So there are two components to the reserve fund. So there's the reserve fund allocation. That's the annual amount that you're setting aside for spending, and then there's the actual spending that comes out of it. So what I just spoke about was the spending that came out of it. So I'll just give you a couple of comments on that annual allocation that is set aside every year. So that's a big piece of the budget. That's typically around 1/3 on average of maintenance fees that's allocated to the reserve fund every year. So this is the required amount based on the Condo Act that every condo has to set aside to pay for that future major repair and replacement. And this is recommended by the engineer in their reserve fund study, and then it's communicated to owners in the notice of future funding. So the Condo Act requirement is to make these allocations based on what the engineer proposes in their reserve fund study. And there are typically increases every year in that study, with an even higher increase every 3 years when that study is required to be done again. So we get asked questions a lot, whether directors are required to make these allocations that the engineer proposes. So the extremely technical answer is no. I know Catherine referred to auditors as the condo police, but there are no condo police that are going to fine the condominium if you don't follow the engineer's recommendations. That doesn't mean that there aren't significant, quite severe consequences. The first consequence of not following the engineer's recommendations is that the engineer will point it out in their notice of future funding that's communicated to owners. So that's the first touch point. The owners are being informed that, hey, the board is not following the advice of a professional. The second consequence is that we as auditors, we will point it out in our audit report to the owner. So now that's the second touch point, that owners are being informed. And another consequence, which may not be immediate, but it's equally important, is that eventually you may just not have enough in your reserve fund when it comes time to undertake certain projects or replace certain components of the building. The engineers, they do a lot of work along with the manager's input to come up with that estimate of how much is required to be set aside annually so that your condo eventually has enough to pay for those reserve costs. So it's prudent that as a board, that you follow those recommendations in the budget in accordance with that reserve fund study, so that directors don't expose themselves to liability because they're not following a professional's advice. So, Catherine, we've kind of gone over the reserve fund. Is there anything else that corporations should be considering in month 10 and 11?
In month 10 and 11, I'm going to start talking a little bit about how to plan and prepare for your actual budget meeting. So the other piece, the other awareness that comes when you're not funding your reserve fund properly is in the PIC. And I mentioned before, wanting all of your communications to align, because the idea of all of those new notices under the Modified Act was to make sure that folks who are living in condominiums, their greatest asset, know how their money is spent and understand it. In month 10 is when you're going to have your budget review with the board of directors. And what I do recommend is to get familiar before the board meeting with your budget. And you should know and understand what 1% of change would mean in dollars and cents. And one of the reasons why I say that it's typical, perhaps, to have an agreement as a group that you're going to run through the budget and you're maybe not going to make change unless it is going to equal 1%, because maybe it's irrelevant if it's not going to make 1% worth of change. Understand committed spending. That is, again, work that can be done in advance. Using the tool of a contract summary might be particularly helpful. And that way you also understand as board members what would represent the status quo, changing nothing, and what would represent an increase or change to the performance levels or the hours of your security staff. I find, and there's been things written about people just not being able to comprehend large numbers. We're just not made for it as human beings. Christina, the exception that makes the rule. I'm obviously a word person. So one of the things that I find helps a great deal is to just drop a bunch of zeros. That way you're talking about, $1, and whether or not, $1 is changed in your budget might give you a better idea as to its relevance. You're next going to go to a line-by-line review. Again, perhaps within the back of your mind, what 1% of budget change will look like. And what I think you should be looking for in your line-by-line review is what the variances are. So what was our budget last year? What did we project we would spend to the end of this year? And what are we budgeting for next year? Again, those variances should be explained by notes and or assumptions that your manager has put together for you. And that's a good place for your discussions to begin. Are those good, reasonable assumptions? Should we be providing for something else or different? And the final thing that we talked about a little bit before are options for a 0% increase. I don't think that a 0% increase is at all reasonable. And that's a problem. And so I think what we will want to do, and we'll talk about it in communications, is to explain what the difference is with all of the changes that are going to be necessary in order to protect our residents under COVID-19. As Mario had mentioned, that is going to be important spending. Use of your surplus is a possibility with some of the cautions that we've mentioned earlier, and your workup on what the changes to specifically electricity rates might mean for your bottom line later in the year could be particularly important. Real options for a 0% increase effectively are going to amount to decreases in services. This is a chart, and I recommend a chart like this for communication of complicated information. Again, I'm a word person, not a numbers person, and a chart like this shows typically what directors can influence. Anybody who's been on a board for a long period of time will know that there's not a lot of sexy spending in a budget. It's all super boring, contracts and utilities. And so when you're looking to drive a 0% budget, the question becomes, what are you going to give up? And reasonably and realistically, a 0% budget, driving a 0% budget is going to mean closures, less frequent window cleanings, less frequent underground garage washes, and things of that nature. A lot of the contracted spending that we have is pretty fixed because the labor rates are fairly consistent. The final question, the big one, is how to communicate it with homeowners. I believe that a lot of detail and information is important. Like I said before, many people think of common element fees as taxes, and I know I don't like paying taxes, but I do like what it buys me. Your notes are going to describe what it is that homeowners are buying with the money that they're giving you. That can be done with a good covering letter, and it will talk to the specific increases and the variances that are most important. The notice of future funding of the reserve fund isn't required to be sent with your budget every year, but I do think it is a good practice. And that's because it contains all of that detail with respect to the reserve fund plan that Christina had mentioned previously. And let's face it, those numbers are not likely to be fore of mind for your individual homeowners. The periodic information certificate, we can definitely go beyond the form. We can talk about some of the specific issues that have confronted our condominium since the last time we sent out a big mailing, whether it be electronic or on paper. And the final thing, and you'll notice where I place this in the presentation, is an information meeting with your owners. These days, probably virtual, so a little bit more like this than anything, but this is your opportunity to answer some of the questions that you might get from your homeowners and to describe in greater detail the spending that's taking place. I make mention of its positioning because it is after the board has set the budget. Budgets are set by homeowner plebiscite. It is the obligation and the duty of the board to set a budget. But we cannot afford it. And I say it just like that because there was a commercial where I grew up that said it just like that, and it makes me laugh a little bit. The information that you send to homeowners has to be meaningful in order for them to be able to connect the dots. And although nobody likes increases, if you communicate with people well, the truth of the matter is they will have the same information that you did as a board and as a manager putting together that terrible increase. And they will begrudgingly agree that that is what we need to do. In some of the preparation materials that had been sent to us by CCI Toronto, the question was, how fast do we have to implement a reserve fund increase? What does adequate mean? As Christina had mentioned earlier, the truth of the matter is in not eating that increase and not starting to contribute to the reserve fund earlier, you are handicapping yourself and your ability to complete necessary repairs and maintenance in future. So I don't like it, but I do believe in getting those increased contributions on the table, in the bank, and as quickly as possible. And the reason for it is that is all homeowner money. It is all in support of their greatest asset. And there's no new money next time around, right? Everything we spend is from the front pocket or the back pocket. If you have read all of or any of that information from your investment planner, they will tell you about the miracle of compounding interest. And that's what we're looking to get into the bucket there. And we're looking for everybody to reasonably and fairly contribute their share. So that's the thing to consider. If you're deferring the contributions to the reserve fund study, there are some people who haven't paid their share of what the roof will cost to repair further down the line. The most common causes for large increases in condo land have been one-time increases to wages. And we experienced that a few years ago, for instance, with significant increases to the minimum wage. New condominiums who don't have a reserve fund study in place, and so they're starting contributions to the reserve fund at an appropriate level, and they also don't have any history of utility spending. Christina spoke a lot about how vital that was in being able to absorb changes in behavior, like what COVID is doing to our utilities currently. Try to avoid the excessive deferrals of payments. It's living on credit is what it essentially is, and we all know that that's not a comfortable environment. What I will now ask, and you'll notice that I'm asking Christina because she sees more condominiums and fees for comparison purposes than any, and she is our dollars and cents queen. So I'm going to ask you to talk a little bit about our comparisons.
Thanks, Catherine, for that generous introduction. Okay, so comparing maintenance fees. So some of those questions that Catherine alluded to earlier, why are our maintenance fees so high, or why is there such a large increase this year? Those questions come from the fact that owners or directors are probably comparing their fees to neighboring buildings or complexes. So that it can be a dangerous exercise because it's just as if you're comparing apples to oranges. No two condominiums are exactly alike. So you can have the same developer build two buildings theoretically side by side. They're mirror images of each other, yet the costs to operate them will likely be different over time. So they might start out being relatively the same, but then eventually you have different communities living in them. You have different individuals on the boards making different decisions. Board of Building 1 might have different rules or policies in place than Building 2. For example, no pets allowed. And those types of factors will definitely impact operating costs over time. The percentage of renters in a building, that also has an impact on wear and tear and will likely impact operating costs as well, which eventually flow into your maintenance fees. And another factor that impacts maintenance fees is how is the building managed? So is the building professionally managed or self-managed? So there's lots of differences. You cannot do an effective comparison of two condominiums without just normalizing for all of these factors. So it is a valid concern that high fees might impact resale value for your condo. But at the end of the day, you get what you pay for. And that should, what you're getting, that should be reflected in the maintenance fees. There's definitely temptation, as Catherine was referring to earlier, to keep fees low just to compete with neighbors. But higher fees for your condo, that might be warranted given that your condo just has a different cost structure. So don't kick the can down the road and keep fees low now, because it will definitely come back to bite you later. So let's say an increase what is required. Catherine, is there any experience you can share about implementing those increases?
I have, of course, had such experiences, and my experience is that they go better than everybody worries about. And again, prepare yourself for the fact that there will be questions and present them with the information that you have. Share what it is you discussed in the boardroom, not the nasty things, because you were all very civil when you discussed it, but why this is the plan and why it needs to take place. We have all heard of some of the extreme circumstances and unfortunate outcomes. Boards worry often, they're gonna, requisition a meeting, Catherine, they'll get rid of us. And at the end of the day, I try to reassure my boards, if that is legitimately the case, you would probably sooner be removed from the board when they make a terrible fiscal choice, because you have director liability. And what you are obligated to do is look after the condominium corporation. What is possible, as Mario referred to earlier, is to make changes to service levels at your condominium corporation if you really and truly want to attend to special needs. But the reality of it is every building has said, Catherine, I'm special. There are so many people of fixed income, so many people who are seniors, so many people who are low income. But at the end of the day, my duty and that of the board is to take very good care of the asset that is the greatest investment that all of those people have made. And what they don't want me to do is to decrease its value or to compromise its saleability. And in being properly funded, you are ensuring that you remain one of the best buildings, the best communities in which to live. You can talk about the options that were available to you instead of the big increase, and that would be special assessment, pros and cons, or borrowing, which requires, of course, the authorization of the community, and of course comes with an extra cost. So I think once you have all of those discussions, it effectively or essentially becomes easier. What I'm going to ask Christina is how we can best smooth out those budgeting pitfalls, manage them best, so that our communities are well educated and we don't have those nasty meetings that we all dread.
Sure. So for cash flow purposes, you've mentioned it a couple of times earlier, Catherine. It's important to have enough. Just you do the annual budget, and it's this one big bucket of costs. But it's important that you have enough throughout the entire year to be paying for those obligations. So when you're budgeting, one potential pitfall that we sometimes see is that all costs for projects come due at the same time, causing a cash crunch. So, Catherine, you alluded to that earlier as well. So when you can smooth out your spending, so for example, certain repairs and maintenance or reserve projects, you should do that smoothing so that you don't have that cash crunch at any given point. Another pitfall that we sometimes see happening when determining your budget is not identifying that certain costs have unique timing. So, for example, utilities, gas is higher if it's used for heating during the winter months. So make sure when you're budgeting for gas that you have your higher gas costs in the winter months. Don't just have a straight gas, just don't smooth it out equally throughout the entire year. If you have a townhouse complex, there might be increased water consumption in the summer months for landscaping purposes. So factor that into your water costs for the summer. And another pitfall, which I can appreciate, in this, even from this webinar, we've given you a lot of details. So it's easy to get overwhelmed. So when you're doing your budget, when you're doing your monthly review of the actuals against that budget, another pitfall is just easily getting overwhelmed. So some advice that we can give you, some costs are predictable. They're easy to budget, and there's not normally large budget variances in these. So for example, contracts, insurance, wages, admin, those are some categories that you can likely spend less time looking at those costs. If you do see a large variance in those costs, it should be flagged, but you don't need to spend too much time there. You likely already know what the causes of those variances are. So for example, if you've budgeted for certain legal costs throughout the year and you see month to month, those legal costs are building up and over budget month to month, you'll likely already know the reason why. Maybe there's a claim going on, or with COVID-19, there's more legal opinions being sought for certain items. So another area that you can just get more bang for your buck is looking at utilities and repairs and maintenance, because number one, these are higher dollar items, and there's also just more risk or potential for things to go wrong in those two buckets. So you just might want to invest some time in those areas in your monthly review. So Mario and Catherine, is there anything from a legal or property management perspective that you want to share about common budget pitfalls that you've seen? Maybe I'll ask Mario first.
This isn't legal, but I think there aren't a lot of condos out there like this, but there's too many. They, short their budget by 1 or 2% every year, and over 30 years, that's a 60% loss. And then they hit the wall, or their condo just falls into bad repair, and that's just bad budgeting. I say always budget for a little bit of surplus every year and build up the contingency fund. That's it.
I agree. And further to what Christina's presented, I hate for boards to have to make choices that they don't want to on account of finances. So building a little bit of a kitty, a little bit of a surplus, goodness forbid you're in a circumstance where you have a legal battle. I hate for you to compromise what should be done legally in the longer term because you have a short-term cash crunch. It's bad business is what it ends up being at the end of the day.
So you do have some questions, not many of them, just I think 4. Will you get a copy of the slideshow? The answer is yes, it will be emailed to you. I think with, I'm not sure about this, but I think with the evaluation. Catherine, there was a question about stack cleaning coming out of the reserve, which it cannot come out of the reserve. I think that's what you meant. Because maintenance can't come out of the reserve, only major repairs and replacements.
If you work with your reserve fund planner, you can use your reserve fund as a planning tool for some of these larger increases. It does have to be part of the plan. So that's what's very vital, very important. So as Christina had presented earlier, it's not a tool to just balance your budget. It's part of a plan.
The other question was, what is, you can have a temporary operating line of credit. what's temporary. What's temporary is what your auditor can accept as temporary, and they're the guys looking over your shoulder. So, but I think a temporary operating line of credit would be no more than a year. But Christina, you might have some other input on that.
Yeah, so Mario, you said we're a team. So first of all, there has to be a borrowing bylaw. So I think from a legal perspective,
Yes.
would you agree that for an operating line of credit, you have to have a borrowing bylaw? I don't think we would restrict and say, because a corporation can also enter into long-term financing, some of these green loans or
But
energy efficient.
I think this question was talking about the borrowing bylaw that all corporations have, which is usually bylaw number 2, that says you can borrow up to 2 months common expenses.
Revolving
that I would
credit.
use.
Revolving,
That,
okay.
right. Yeah. That I would only use for a year. But yeah, I mean, there's no like solid answer on that. But for other borrowings, for sure, you need a budget, a bylaw.
The other thing that I'll make mention of, it's very seldom done in condominiums, but it is possible. You can strike another or a new budget. And this might be one of the years that it's necessary. Mario, you can speak a little bit procedurally to how much notice is necessary if you were to strike a new budget. It's surprisingly little. And given that you can do that without a bylaw, without seeking homeowner approval, it might be the better way forward.
Yeah, it's 10 days, but don't do that because you'll have a revolt. 10 days notice is the legal requirement for issuing a new budget. So literally you have to pay up in 10 days if they issue a reserve fund or a special assessment, and you would never want to do that. The very last question is, how can you get educated on Section 97? Oh boy, Section 97 is a big question. Like I said, there's 3 categories, and then there's exemptions for safety and compliance with legislation. So if you try to read it, you might be able to make sense of it if you're a genius, because I couldn't understand it the first 5 times I read it. So, but there's also blogs all over the place about Section 97. And but basically, there's those 3 categories and then 2 exceptions: safety and security, expenditures, and expenditures that you're making because of legislation. And I think those are all our questions. There's one more. Situation involving towers and a shared facility. Should the shared facilities reserve fund fall into deficit position due to unexpected expenses, what would be the steps to correct this? Interesting. I'll throw that at Catherine.
I think if I understand the question properly or correctly, the shared facilities is in deficit and it is shared between 2 towers. Is that correct, Mario?
Yes.
The steps in order to abate that situation, contributions to that shared facility, I'm assuming, are apportioned between the 2 towers. It means that the 2 towers have to come up with the money to make that shared facility whole. I think thereafter, what you have to talk about and look at is how you are budgeting or spending money in that shared facility so that you prevent that kind of a circumstance in future. The other thing that I am hearing in the question, though it hasn't been stated, it can be the cause or source of a lot of conflict between partners. And so there will be a need for some reconciliation as to how come they are over budget. Why do we not have enough money? Mario can talk a little bit more about shared or reciprocal agreements. Those are documents that set out, and when they're authored well and properly, they give you very good guidance on what comes from a shared facility by way of expenditure and how expenditures are shared.
Well, there's a saying in business: the best partner is no partner. When you have a shared facility, you have a partner, another board, and most of them get along great, but unfortunately, some of them have different budget ideas, different maintenance ideas, and I'm seeing far too often where one corporation simply doesn't want to maintain the common areas of the shared facilities the way that they should be maintained, or that there's fighting over, who's going to be the manager. These are all issues relating to the shared facilities, and they do affect the budget, because if there's a shortfall, because one of the corporations will not vote for the increase in the budget, then there's a huge problem. And the ultimate solution is one that you really don't want, which is mediation and arbitration, unfortunately. That's very expensive, and it doesn't usually lead to an ideal result. Both parties will be disappointed, usually, but that's the ultimate solution to that problem. And I think we have reached the end of the seminar and the questions. I don't see any more questions. We did answer them all. I would like to thank everyone for attending. Please look for our next seminar on climate change. It's on our CCI-T website. I'd like to thank Catherine Gao and Christina Adjeth, who did most of the work, and an excellent presentation by both of you. Thank you very much. And again, thank you to our conference or our webinar sponsors. And looking forward to seeing all of you at our future webinars and events. Thank you very much.